Hey everyone, and welcome back. Today, we're jumping right into the deep end of the crypto market, because what's happening right now in mid-March 2026 is, well, it's chaotic, it's confusing, and it's absolutely fascinating. On the surface, things might look pretty good, but trust me, there's a huge disconnect brewing just beneath the numbers.
Okay, so let's get into it. You take a quick look at the market, and what do you see? A sea of green. You've got solid gains for the big players. Bitcoin, Ethereum, XRP, they're all ticking up. And this is the kind of chart that usually has everybody popping champagne. But, like so many things in crypto, looks can be really, really deceiving.
And this is where things get weird. Look at that number, 32. That's where the Crypto Fear and Greed Index is sitting right now. So even with all those green prices, the needle is pointing straight at fear. Just so you know, anything below 50 means people are getting anxious. So 32 tells us there's this really deep unease in the market. There's a total disconnect between asset prices and how investors are actually feeling. So what in the world is going on?
Well, to figure that out, we have to start with the king, Bitcoin. Its recent moves have been more than just a wild ride for crypto traders. It's basically been acting like a canary in the coal mine for the whole global financial system, and it's sending a massive warning shot to Wall Street.
And you can see it right here on this timeline. Just look at how sensitive this thing has become. In early February, Bitcoin crashed down to 60K before the global stock market took a nosedive. Then it started to bounce back, and guess what? It pulled traditional stocks right up with it. And now? It's rallying past $71,000, pretty much just shrugging off the weakness we're seeing in stocks. It's become this leading indicator for risk, and believe me, traders everywhere are glued to Bitcoin's chart, not just for crypto, but for clues about the whole global economy.
But here's the thing. Bitcoin's price, as important as it is only one piece of the puzzle. The real drama, the stuff that could seriously define the next decade of finance, is actually happening on the foundational platforms themselves. And that brings us to Ethereum.
All right, let's talk about Ethereum. So there was this massive network upgrade called Fusaka that rolled out. It was designed to solve Ethereum's biggest headache, insane fees and slow speeds. But in the process of fixing the network, it might have accidentally unleashed some really severe unintended consequences that are now shaking its entire economic foundation.
So before we get into those consequences, you need to understand this new threat that's just exploded since the upgrade. It's called address poisoning, and it's a deceptively simple but incredibly dangerous scam. Basically, a hacker spams your wallet with a tiny worthless transaction from an address that looks almost identical to one you've used before, maybe just one character is different. And the whole goal is to trick you into accidentally copying their address for your next big transfer.
So what does that matter now? Well, the Fusaka upgrade slashed transaction fees by over 90%. And while that sounds great on paper, it also made these poisoning scams super cheap to pull off on a massive scale. And the result? Just look at this. As of last month, these spam attacks now make up over 22% of all transactions on the Ethereum network. I mean, think about that for a second. Almost 1 out of every 4 transactions on the world's biggest smart contract platform is just malicious spam. That's insane.
And this flood of spam has created this just devastating ripple effect. The network is clogged with these practically free transactions, so the money paid to the validators who secure the network is totally cratered. That makes staking your ETH way less attractive. And the fee-burning mechanism, the thing that was supposed to make ETH deflationary, has been seriously weakened. So now ETH is inflationary again, and it's getting so concerning that even its co-founder, Vitalik Buterin, has been selling off millions of dollars worth of it.
So what we've got here is this fascinating split happening in the market. You have Ethereum, which is supposed to be the beating heart of decentralized finance, battling this self-inflicted economic crisis. And at the exact same time, another crypto giant is quietly making huge moves with the very institutions Ethereum was hoping to attract.
Which brings us to XRP. Ripple, the company behind it, is playing a completely different game. Instead of this tech-first approach, their entire strategy is focused on regulation, compliance, and building regulated bridges to connect with old-school traditional finance.
And if you look at the on-chain data, you can see something big is happening. In just the last 30 days, the volume of real-world asset transfers on the XRP ledger has shot up by, get this, 1,282%. Now, a spike like that's not driven by everyday retail traders. It's leading a lot of analysts to believe that the big institutional on-ramps are starting to switch on.
And this growth isn't random. It's part of this methodical, global strategy that's been playing out.
First, you get regulatory clarity, right? Like getting a 100-year-old French bank to list XRP under Europe's big MiCA framework. Then you unlock key countries by getting payment licenses. Next, you integrate yourself directly into the core financial plumbing, like becoming a network for the DTCC, that's the group that clears every single stock trade in America. And finally, you collaborate with giants like MasterCard on the literal future of money.
So what we're really watching here is crypto arriving at this massive crossroads. You've got two of the biggest players in the game, not counting Bitcoin, and they are chasing two completely different visions for how to build the future of finance.
And it really all boils down to this split in philosophy. Ethereum's whole approach is technology first. The idea is, let's build the most advanced, scalable tech, and adoption will just naturally follow. The risk, as we're seeing now, is that a technical fix can have some really nasty economic side effects. XRP's approach is the total opposite, adoption first. They're building the regulated, compliant pathways for the big money now, and letting the tech serve that purpose. The risk there, of course, is that you're relying on these huge, slow-moving traditional partners.
And the stakes in this race could not be higher. The World Economic Forum estimates that almost 870 times $1 trillion worth of real-world assets are going to be tokenized by 2030. To put that in perspective, that is more than 10 times the current global GDP. That is the monumental prize that both of these networks, in their own very different ways, are fighting for.
So this brings us right back to that crossroads. Is the future of value going to be built on the most elegant, decentralized technology, or is it going to belong to the network that's most deeply woven into the existing financial system? That right there is the multi-trillion-dollar question that's defining the market today. Which path do you think wins? We'll see you next time.